Welcome back to Talk Tickers. You know the drill here.
No fluff, just the numbers, the narrative, and all the noise.
Exactly. And today we are stripping down the Q4 2025 print from the absolute titan of the sector, Johnson & Johnson. Ticker is JNJ.
And this is one of those prints that really makes you, check your assumptions. Usually J&J is like watching paint dry on a battleship. It's big, it's slow.
Predictable.
Totally predictable. But this was different. We're looking at a healthcare giant that just beat on the top and bottom lines, and then, they just raised the roof on their 2026 guidance.
Right. On paper, it looks like a total victory lap. But if you were watching the tape, you'd think they missed by a country mile.
Oh, yeah.
The stock indicated down, by 2.9% in the pre-market? And it just traded soft all day. The market voted with its feet.
It really did. It wasn't a standing ovation. It felt more like a walkout. It's that classic show me sentiment.
Show me the money.
Exactly. Management's out there calling this a catapult year, saying they're launching into this new era of growth. But investors are looking right past that headline beat.
And what are they staring at?
Two things. Competitive pressure in MedTech and the massive ghost of Stelara.
So that's the conflict we need to unpack. Why the disconnect? Is this a buying opportunity or is it a value trap hiding in plain sight?
Let's dig in.
Okay, let's start with the hard numbers. What did the scorecard actually look like?
Well, the headline numbers were undeniably hot. Revenue came in at $24.56 billion.
And the street was looking for...
Consensus was around $24.16 billion. So a really solid beat. That's a 9.1% year-over-year jump.
And that is not a small jump for a company of this scale. This isn't some high-flying tech stock.
Exactly. I mean, moving the needle 9% on a base that large is significant. And just to put a bow on the full year, 2025 revenue crossed $94.2 billion. That's up 5.3% operationally.
Okay. And EPS.
Adjusted EPS hit $2.46 for the quarter, which was, pretty much in line with what everyone expected.
So 2025 is in the books.
Yeah.
But the market trades on the future, right? So what are they telling us about 2026? Because that guidance sounded aggressive.
Aggressive is the word. Management is projecting 2026 sales between $100 billion and $101 billion.
Wow.
Yeah. The midpoint there is 6.7% growth. And here's a key stat for you. J&J is poised to be the only healthcare company to break that $100 billion annual revenue barrier.
That's a staggering amount of money. It's like the GDP of a mid-sized country flowing through one single company.
It is. And on the earnings side, adjusted EPS guidance is set at $11.43 to $11.63. So the C-suite is yelling from the rooftops, we are growing and we are growing fast.
But the market reaction was to open around, $211? Down from a close of $208. The street is just fading the beat.
Completely.
So let's dig into why. We have to start with the innovative medicine division, what we all used to just call pharma, because there is a very large, very expensive elephant in the room.
Stelara.
The revenue collapse there was...
Yeah.
It wasn't subtle.
No, it was a cliff dive. Stelara revenue collapsed 48.6% in the quarter.
Almost half.
Almost half. And this is the biosimilars hitting the market, plus the Part D redesign. We all knew this was coming. It's a loss of exclusivity event and LOE. But to see a nearly 50% drop in one go is jarring.
And for anyone who isn't deep in the regulatory weeds, that Part D redesign is really important context. It shifts more cost liability onto the manufacturers.
Exactly. So you get hit on volume from generic competition, and at the same time, you get hit on margin. It's a double whammy.
So when management says this is in the rearview mirror...
I mean, technically, sure, the worst of the drop has happened. But when you lose that much cash flow from a flagship drug, you need the cavalry to arrive immediately. You can't just wait for reinforcements.
So did the cavalry arrive? Let's look at the offsets, because while Stelara is in a nosedive, the rest of the portfolio seems to be on fire.
It really does. I mean, the star of the show here is Trumpia. This is their big answer to the Stelara loss.
Okay.
It posted 65% growth worldwide. It's now the fastest growing IL-23 inhibitor in the U.S.
65% growth on a drug that size is really impressive. That's not a small base to grow from.
It's massive, and they're positioning it as a future $10 billion asset. It's doing some very heavy lifting. Then you've got Darzalex and Oncology.
Ah, the gold standard for multiple myeloma.
The gold standard. It grew 24%. It's just a volume machine. We're talking about a $14 billion annualized juggernaut and it's still growing at 24%. That covers a lot of sins.
And you can't ignore the cell therapy side, right?
Yeah.
Carvykti, this is one of the hottest areas in biotech.
Up 63%. They've treated over 10,000 patients now. This is their core T therapy, and for anyone not familiar, it's where they basically take your own T cells, engineer them to hunt cancer, and put them back in.
It's basically sci-fi becoming standard of care.
It is. And crucially, it's moving into earlier lines of treatment, which just explodes the potential market.
I also saw Spravato, the nasal spray for depression, is absolutely flying, up almost 68%.
It is, and that's a key part of the story. It's not just one drug replacing another. It's a whole basket of high-growth assets. You've also got Rybrevant in lung cancer, up 76%.
So the argument for management is essentially, Stelara is dead, long live the new kings.
That's it, exactly. And they have another weapon coming, a drug called icotrokinra, or ICOT. It's an oral IL-23 peptide for psoriasis coming in 2026.
An oral peptide. That's a big deal because the current standard is injections, right?
Right. If you can offer a patient a pill instead of a needle with similar results, you win. They're framing it as a market expander.
The CEO, Joaquin Duato, he was really explicit about this. He said they have a line of sight to double-digit growth by the end of the decade.
Which is an incredibly bold promise for a company this mature. He's basically staking his reputation on the idea that these new launches will not just fill the Stelara hole, but build a mountain on top of it.
Okay, so if pharma's doing its job, if the transition's actually working, why the sell-off? Has to be MedTech. Reading the analyst notes, that's where all the anxiety was.
That is exactly where the battleground is. MedTech grew 5.8%. Now, in a vacuum, that's a solid number for a mature medtech business.
But not for JNJ.
Not for J&J. This is where the concern lives. If you break it down, cardiovascular looks strong on the surface.
Yeah, the acquisitions seem to be working.
They are. Shockwave was up 23%. Biomed and the Impella heart pumps up 18%. They bought growth, and they are absolutely getting it.
But then you hit the sore spot, electrophysiology, or EP. For years, this was J&J's kingdom.
It was the crown jewel, and EP grew 6.5%. Now, for most divisions, 6.5% is fine. But for J&J's EP business, where investors are used to seeing double-digit growth, 12, 15%, this is a major deceleration.
And the reason for that deceleration has a three-letter name, PFA.
Pulse field ablation.
Yes. We've touched on this before, but let's quickly explain the stakes.
Sure. So traditional ablation for heart arrhythmias uses heat. It burns the tissue. PFA uses electric fields. It's cleaner, it's faster, and it's generally safer. It's the new tech.
And J&J was late to the party.
They were late. And the market is worried that competitors like Boston Scientific and Medtronic are just eating J&J's lunch with their PFA systems. That 6.5% growth number suggests rivals are taking share.
But J&J wasn't just rolling over on the call, were they? They were pretty defensive.
Very defensive. They said they aren't rolling over. They pointed to their own PFA system, Varipulse, which has done 40,000 cases, and they made a really specific promise.
Which was?
A new catheter launch every single year through the end of the decade.
A new catheter every year. That's an aggressive hardware schedule.
It is. They're trying to tell the market, we might be late to PFA, but we're going to own the ecosystem. They have the CARDO mapping systems, which is the industry standard. They think that integration wins in the end. But for now, the market sees 6.5% and gets nervous.
Okay, what about the other big medtech story? Robotics. We've been hearing about OTTAVA forever.
It feels that way. But we finally have movement. They submitted OTTAVA for FDA de novo approval.
That's a huge milestone. This is their answer to the Da Vinci monopoly from Intuitive Surgical.
It is. Just getting to submission is a win. And they're moving into urology with Monarch for kidney stones, too. They're trying to cover all the bases. But there was one other number in medtech that spooked people.
Tariffs.
The CFO, Joe Walk, noted a $500 million headwind expected in 2026. And that's largely a medtech problem because of the global supply chains for devices.
$500 million is not a rounding error, even for a company this size.
No, it is not. So you start to tally this up. You have slowing growth in EP, tariff headwinds, a massive patent cliff. You can see why the stock traded soft.
It creates a narrative problem. But in that context, what are they saying about margins?
That's the impressive part. Despite the tariff hit, they're projecting a 50 basis point operating margin improvement in 2026.
Wow. So they're finding efficiency somewhere else.
They are squeezing the lemon hard, and part of that is the ortho spinoff.
Right, the strategic pruning.
Exactly. The separation of the orthopedics business is on track for mid-2027. Ortho is a lower growth, sort of commoditized business, hips and knees. By spinning it off, the remaining new J&J should have a baseline growth rate closer to that 6-7% consistently.
It's addition by subtraction. Get rid of the slow runner so the team's average speed goes up.
That's the idea. It becomes a pure play, higher growth pharma and advanced MedTech company.
Okay, before we get to our trade idea, we have to touch on the litigation. The never-ending talc saga. There was a ruling yesterday.
The Doberg ruling, yeah.
And that's about what expert testimony is actually admissible in court.
Correct. And it was a mixed bag. The court tossed some of the plaintiffs' junk science, which is a clear win for J&J, but it allowed other parts to proceed. So J&J is appealing.
Management's stance seemed pretty defiant.
The quote was, "We will not be distracted." They're signaling this is a long-term fight. They are not looking to settle anytime soon.
And while they're fighting, they're just printing cash.
An obscene amount of it. Free cash flow for 2025 was about $19.7 billion. They're targeting $21 billion in 2026. Their balance sheet is an absolute fortress.
So putting it all together before the trade, you have a company navigating a huge transition, losing its biggest drug, fighting a tech war in heart surgery, dealing with tariffs.
But they're still printing $21 billion in cash and promising double-digit growth down the line. It's a massive ship that's turning, relatively quickly. The market just needs proof that MedTech can get back to double-digit growth.
Okay, that brings us to the part of the show where we stop being analysts and start thinking like a hedge fund.
Let's get speculative.
This is not financial advice segment. Please do your own homework. What is the trade?
I'm calling this one the cyborg bladder arbitrage.
I love it already. Unpack that for me.
So the market is completely obsessed with Stelara and the heart business. They are ignoring what's happening in urology, specifically a device called Inlexo, which is part of their TAR-200 platform.
This is the pretzel-looking thing, right?
Okay.
I remember this.
It's a silicone pretzel-like device. You insert it into the bladder, and it releases drugs, chemo, or immunotherapy over time directly into the organ. Think about what this does. It saves patients from a radical cystectomy.
Which is?
Complete bladder removal. It's a life-altering, traumatic surgery. If you can avoid that with this device, the value proposition is just infinite. It's about quality of life.
So high value, what's the catalyst?
The J code. That's the insurance reimbursement code. It hits in Q2 2026. Once that code is live, insurance pays for it, and utilization is going to go vertical.
So what's the trade structure? How do you play it?
You go long J&J, specifically for this MedTech breakout in urology, but you pair it. You go short the traditional urology surgical centers or the hospital chains that make a ton of money from radical cystectomies.
So you're betting on technology disrupting a surgical procedure.
Exactly. The cyborg bladder replaces the scalpel. The market has not priced in how fast that standard of care will shift once that insurance code goes live in April. Hospitals lose a high billable surgery. J&J gains a recurring revenue device.
I like it. It's a play on innovation that's buried deep in the footnotes. It's the kind of thing the algorithms miss.
Mm-hmm.
Do you have an alternative for the slightly less adventurous?
A simple pairs trade. Go long J&J and go short the pure play EP competitors.
The ones who are supposedly eating their lunch right now, the Boston Scientifics of the world.
Right. The whole thesis is that the market has over-penalized J&J for being late to PFA. They think J&J is dead in the water. But with Varipulse and this Omnipulse catheter coming, they are going to reclaim share faster than the street expects.
So you're betting on a mean reversion. The pure plays are priced for perfection, and J&J is priced for failure.
That's it. And when J&J starts dropping a new catheter every single year, that valuation gap is going to close fast.
Fascinating. So J&J is down, but definitely not out. It's a transition story with a fortress balance sheet.
That's the bottom line. The revenue is there, the pipeline is working. But that show me sentiment is real. We'll be watching for that J-code in April and any progress on the OTTAVA robot.
And as always, none of this is financial advice. Keep your stop losses tight.
Do your own homework and don't fight the FDA.
This is Talk Tickers. We'll catch you on the next print.